Let's start ratio analysis. Okay. What do you mean profit margin and turnover ratio? How are they going to vary from one industry to another industry? Right. What a difference would you expect to find? Grocery chain is such as Big Bazaar and steel companies such as Tata Steel. Okay. What is profit margin ratio and turnover ratio from one industry to another industry? Definitely is going to differ. So ratio formula remains same. In the context of the company, it will differ. Correct? No. So profit margin. So profit margin is equivalent to so profit into 1 minus tax rate, net profit to 1 minus tax rate by sales into 100. In case of turnover ratio, that is equivalent to any turnover ratio. There are a lot of turnover ratio available. For example, asset turnover ratio. Asset turnover ratio is equivalent to turnover by asset. For example, investment in asset is going to be 100 lakhs. Your sales is going to be 10 lakhs, which means your sales is very poor, 0.1 times. Suppose, for example, your asset is 10 lakhs, your sales is 100 lakhs. You are doing super business, which means 10 times, 10 times. So asset turnover ratio is going to be here 10 times. That's it. So automatically there is always a difference between the comparing the two companies. That's it. Okay. So for example, steel company needs a great number of rupees in assets. Correct. 100% sure. They need to have investment in more fixed asset. For example, steel company, they need to have more amount in fixed asset. But in case of grocery store, so they need to have a more investment in current assets. That's what is always different. For fixed asset is going to be more important for industry, steel industry. Current asset is more important for grocery industry. So therefore, ratio wise also they will differ. That's it. What is the main purpose of higher turnover? Higher turnover is always good for the company. Whether it's going to be current asset turnover or fixed asset turnover is always good for the company. Suppose what is current asset turnover ratio? That is equal to sales numerator by current asset. That is also always good for the company. Sales by current asset. That's it. That is also always good. Always going to be good. That's it. So sales by current asset. Similarly, what is fixed asset turnover ratio? Same thing. That is equal to sales by fixed asset. So that is also always good for the company. That's it. So more we have a turnover, it is better for the company. That's it. Better for the company. I told you here, for example, sale is going to be 100 lakhs. Inverse fixed asset is going to be 10 lakhs, which means 10 times. So the fixed asset turnover ratio is going to be 10 times. That's it. So large turnover is always associated with low profit margin, sometimes vice versa also. That's it. Sometimes large turnover ratio means maybe connected with fixed asset, but any large turnover will be associated with low profit margin also. Sometimes. Okay, because in case of steel industry, a lot of investment in fixed asset. So profit margin always will be reduced, and vice versa also. That's it. It all depends upon company to company. That's it. Next one, 2012 paper. So state the importance of accounting ratios. A long-term creditor interested in determining whether his claim is adequately secured or not. If a long-term creditor is interested in determining whether his claim is adequately secured or not, what ratio is required? DSCR. We need two ratios. Suppose in case if you're going for a bank to getting a loan, they will always asking you DSCR ratio, debt service cover ratio, or they will ask you interest coverage ratio. They will ask you DSCR, they will ask you, or ICR, they will ask you. That's it. Our long-term creditor, they are interested now, they will always ask you DSCR or ICR. Debt service coverage ratio. That's very important. DSCR. DSCR means whether the company is able to repay principal interest properly. DSCR. Whether the company can able to pay the interest properly. ICR. Interest coverage ratio. That's it. Next one. A bank was approached by a company for a short-term loans and overdraft. But generally, definitely what the bank people always ask the company, sir, please prepare your current ratio. Please prepare your quick ratio. Based on that, we're ready to give loans to you. That's it. Automatically, so they have to prepare current ratio. That is equal to current as will be current liability. Similarly, quick ratio or liquid ratio. A liquid ratio that is equal to liquid as will be current liability. That's it. So automatically you have to check current as will be current liability, liquid ratio, liquid as will be current liability. That's it. The purpose of the ratio no, to get a short-term loans. If they have more current ratio and liquid ratio, automatically loan they can able to get immediately, especially short-term loans. That's it. Next one, shareholder is examine his portfolio, decide whether he should hold or sell his company. That's it. A shareholder is going to examine his portfolio who is decided to whether should hold the company shares or are ready to sell the shares. That's it. What kind of things he was always looking for as a shareholder? My expectation for the company is always with ROE. I'm the shareholder in the company. I'm always thinking about ROE, return on equity. That's it. ROE. That is equivalent to earnings by equity funds into 100. ROE you're looking for. Next one, similarly, number 2 factor I'm looking for is called earning per share, EPS. EPS is equivalent to earnings by number of equity share outstanding. Number 3, DPS, dividend per share. That is equivalent to dividend, total dividend by number of shares, number of equity share. So that's the dividend per share. That's it. So as a shareholder, I'm interested to know about ROE for the company, earnings per share for the company, and the dividend per share for the company. That's it. Next, what is the meaning of debt service cover ratio? Already explained. What is significance? So suppose you're going for loan or any overdraft, always the banking people are asking you, sir, please prepare debt service cover ratio. Please go to your auditor and please prepare DSCR. So then we'll think about our loans. That's it. What is the purpose of debt service cover ratio? Whether the company can able to repay the principal and interest properly. That's it. Whether the due amount of principal can be paid properly, the interest can be paid properly. That's a seen as DSCR, debt service cover ratio, DSCR. That's it. So what is the formula for DSCR? DSCR is equal to PAT plus depreciation plus interest on loan by interest plus loan repayment principal. That's it. So PAT plus depreciation interest numerator by interest plus principal denominator, it is called DSCR. The purpose of DSCR is nothing but whether the company can able to repay the loans properly with interest. That's it. So key indicator, especially for loan purpose. Any banks, they're going to sanction any loans to a company, they're always looking for DSCR. Healthy DSCR means the company can able to pay principal interest properly, automatically loan can be sanctioned. That's it. So can you pay the loan installment properly? Yes, because we have more DSCR coverage ratio. That's it. So ratio of 2 will be ideal, so that it's going to cover DSCR, principal and interest. So DSCR 2 is ideal always. Ratio between numerator by denominator is going to be 2 means which is ideal one. That's it. DSCR 2 is going to be ideal. So better the company can able to repay the debt properly. That's it. It is ideal ratio. Ideal. DSCR is going to be ideal. That's it. Ideal. So PAT plus depreciation plus interest by interest plus loan repayment. It's called DSCR. That's it. Next one. Let's start with the question now. Let's see on paper, 2008 paper. It's going to be 2008 paper. Let's see. Complete the balance sheet and sales information in the table below for the Godrej Industries using the following information. Debt ratio 50%. Liquid ratio 0.8. Total turnover 1.5. Day sales outstanding 36.5, which means debtor turn ratio, debtor collection period. It's going to be debtor collection period or average collection period. So 36.5 days, the debtor will make a payment to you. 36.5 days. That's it. GP ratio 25%. GP ratio is going to be 25%. Next one, inventory turnover ratio. That is equal to 5x. COGS by average stock or simply stock. So 1 year is equal to 365 days. Accounts payable question mark. Long term debt given. Common stock, share capital question mark. Return is given. So total liability and equity question mark. Cash question mark. Account receivable question mark. Inventory question mark. Fixed question mark. Total asset equal to 3 lakhs. Now automatically total liability also 3 lakhs. That's it. Total asset 3 lakhs means total liability also 3 lakhs. That's it. The total liability also 3 lakhs. Missing figure you have to find out. That's it. Let's start how to solve the sum. Right. First one, what is known item actually? Let's start with one by one. We know debt ratio, that is 50%. We know total assets. Right. So first one, I'm going to use debt ratio. Debt ratio is nothing but debt by total asset. Debt by total asset. That is equivalent to 50%. I know your total asset, that is going to be 3 lakhs. Numerator debt missing. Now that is going to be 50%. So debt is equivalent to, can you multiply? So 3 lakhs into 50%. 3 lakh into 50%, that is equivalent to 1.5 lakhs, 1.5 lakhs, 1.5 lakhs. That's called debt. No, that's called debt. So it is called 1.5 lakhs. Debt means total debt, total debt, total debt that is going to be here, here. So 1.5 lakhs, 1.5 lakhs debt, 1.5 lakhs. Already I know accounts pay, I know long-term debt. So accounts payable balance is going to be 90,000. Please check it out. 1.5 lakhs minus 60, 90. 1.5 lakhs minus 60, 90. Because total debt is going to be 1.5 lakhs. 90 lakh accounts payable. That's 90 lakhs going to be accounts payable. Please check it out. 90 lakhs going to be accounts payable. Accounts payable. That's it. 90,000. Sorry. 90,000 is going to be accounts payable. That's it. Because overall debt 1.5 lakhs. Long-term debt is known 60,000. Balance 90,000 going to be accounts payable. That's it. Okay. Next one. Next one. Similarly. Next I'm going to apply. One by one we're going to slowly apply. Okay. Right. Let's see. Similarly, common stock. One is missing, no? Common stock. Out of 3 lakhs, what is the balance sheet figure? Please subtract. Please subtract. The balance sheet figure is going to be common stock. The balance sheet is going to be common stock. Common stock. Please subtract the balance sheet figure. So 3 lakhs minus 90,000 minus 60, 97. Balance sheet figure. So it's going to be 52,500. 52,500. Please check it out. 52,500. Out of 3 lakhs, please subtract 9 lakhs, 90,000. Please subtract 60,000. Please subtract 90,500. So balance going to be 52,500 common stock. Common stock 52,500. That's it. Next one. Okay, let's see one by one. One by one. Let's start with the total asset turnover ratio. Total asset turnover ratio. Okay, we use this one so far. Next ratio slowly will apply. Okay, let's start with total asset turnover ratio. Total asset turnover ratio. I'm going to apply this ratio. This ratio. See total asset turnover ratio. That's it. So total asset turnover ratio is equal to your sales by total assets. Your sales by total assets. Your total asset 3 lakhs. Your total asset 3 lakhs. Sales a question mark. But total asset turnover is given already. That is going to be 1.5. 1.5 is already given 1.5. That's it. So sales is equal to 1.5 into 3 lakhs. That is equivalent to 4.5 lakhs. 4.5 lakhs. 4.5 lakhs. Sales equal 4.5 lakhs. That's it. Okay. Next one. Day sale outstanding. Day sale outstanding. Day sales outstanding 33.5 days. The sales equal to credit sale. Okay. So debtor or accounts receivable. That is equal to debtor or accounts receivable is equal to credit sale into 36.5 days average collection period by 365. Average collection period by 365. That's it. So 36.5 days by 365. That is equal to debtor. What is credit sales here? 4.5 lakhs into 36.5 by 365. Please cut 36.5 by 365 10. So 0 cut is going to be 45,000. So anyway, debtor is equal to 45,000. Debtor is equal to 45,000. That's it. Debtor is equal to 40,000. That's it. Please check it out. 45,000. Accounts receivable is equivalent to 45,000. That's it. Please substitute account receivable equal 45,000 here. Account receivable 45,000 here. That's it. 45,000 here. Next one. Select next ratio. GP ratio on sales 25%. GP ratio that is equal to gross profit by sales. That is going to be 25%. 25%. Already sales is equivalent to 4.5 lakhs. Sales is equivalent to 4.5 lakhs. that is equal to 25%. GP is equal to 4.5 lakhs into 25%. 4.5 lakhs into 25%. So 4.5 lakhs into 25%. Now that is going to be 112,500. That is going to be GP. 112,500 GP. The GP equal 112,500. That's it. Once GP is known, we can find COGS, cost of goods sold. Cost of goods sold is equal to sale minus gross profit. Sale already 4.5 lakhs. Gross profit 112,500. Please subtract. We have COGS. COGS can be used for stock. Can be used for stock. COGS can be used for stock. That's it. Can be used for stock. That's it. So 4.5 lakhs minus 112,500. 112,500. Now that is equivalent to 337,500. 337,500. That's it. It's going to be COGS. COGS. That's it. Now 337 is going to be COGS. That's it. Please check it out. COGS. Okay. Once COGS is known, we have stock turnover ratio. See, inventory turnover ratio is equal to 5 times. 5 times. 5 times. So inventory turnover ratio is equal to COGS by average stock. That is equivalent to 5 times. 5 times. 5 times. COGS 337,500 by average stock. By average stock. That is question mark. That is equivalent to 5 times. Stock is equivalent to 337,500 by 5. By 5. So stock is equivalent to 67,500. That is stock. 67,500 is equal to stock. Stock is equal to 67,500. 67,500. That's it. Stock is equal to 67,500. That's it. It's going to be stock. So 67,500 is going to be stock. That's it. Right. Next one. Stock known. Any other idea? What is the turnover is given? Right. Balance one. Quick ratio. Quick ratio. Quick ratio 0.8. Quick ratio 0.8. 0.8. Let's start with the quick ratio. That's the liquid ratio. Liquid ratio equal liquid asset by current liability. Liquid ratio by current liability. That is equal to 0.8. 0.8. 0.8. See, what is current liability here? That is accounts payable. Accounts payable is the current liability. That is going to be 90,000. 90,000. Within operating cycle, what are you payment? You're going to make a payment is called current liability. That is 90,000. So liquid asset by 90,000. Liquid asset by 90,000. That is equal to 0.8. So liquid asset is equal to 90,000 into 0.8. It's going to be 72,000 liquid asset. A liquid asset is going to be 72,000. That's it. So current asset is equal to liquid asset plus say stock. Liquid asset 72,000. Stock 67,500. We'll be getting current asset 70,000 plus 67,500 is going to be 139,500. That's current asset. Current asset. 135 current asset. So 135 current asset, which means current asset consists of debtor, stock, cash. Debtor here, receivable here, debtor means receivable here, 45,000. Receivable here, 45,000. Stock 67,500. Stock 67,500. So cash missing. That's it. Missing. So 139,500 minus 45,000 minus 67,500. That is equivalent to 27,000. That is equivalent to 27,000. That's it. So 45,000 plus 67,500, 20,000 cash. That's it. So cash is known 27,000. So can you substitute cash here? That's it. Cash how much? Balance 27,000. That's it. Can you substitute 27,000 here? That's it. All the ratios used. Balancing figure, fixed asset. Fixed asset. Balancing figure, fixed asset. That's it. So 3 lakhs minus 27,000 minus 48,000 minus 67,500. That's it. Balance 160,500. 500. That's it. That's the balance 160,500. That's it. Please check it out. So cash 27, 45, 65. So total is going to be 3 lakhs. Please check it out. 3 lakhs. That's it. So balance amount. That's it. So 3 lakhs minus 27,000 minus 67,500 minus so 3 lakhs minus 27,000 minus 45,000 minus 67,500 is going to be 160,500. That's it. That's the answer. Let's call fixed as the balance figure. That's it. Let's see next one. Suddenly Mesa achieved sales of 40 million rupees, 40 million, and net profit of 5 million in the year ended 31/3/2011. The following figures are extracted from the accompanying balance sheet of 31/3/2011 for the company. So paid up equity share capital 5 million, R&S reserve surplus 3 million, long-term loans 8 million, current liability provisions 4 million. The company wants to increase return on equity by 7.5% in the year ending 31/3/2012. So the company wants to increase ROE. They want to increase ROE by 7.5% in the year ending 31/3/2012. That's it. Assess the change needed. Suppose net profit margin they want to change. To meet the desired increase in ROE, they want to increase ROE by 7.5%. Automatically, what are the things we have to change? What is the change needed in the net profit margin, especially to change the increase in ROE to 7.5%? They are going to increase by 7.5. That's it. Whatever the ROE now plus 1.5, they have to increase. They have to increase. That's it. Okay. So let's start with the first one. ROE you have to find out by using this case. But definitely you have to apply DuPont chart only. DuPont chart. DuPont chart you have to apply. DuPont. According to DuPont, return on equity is equivalent to multiply of three things. Number one, net profit by sales. Number two, sales by total asset. Number three, total asset. Number three, total asset by equity. So NP by sales by total asset by equity. That's it. It's a multiple of three things. That's it. Okay. Let's start with one by one. First one, NP, net profit. Net profit you have to find. Before that, you have to know everything. Total asset you have to find. What is total asset known here? Right. Let's start with one by one, all the information. Straight away substitute, you'll be getting the answer. So total asset. Total asset is going to be paid up capital. Paid up capital, 5 crores. 5. Already they have paid up capital. Paid up capital 5 million. R&S 3 million. Reserve surplus 3 million. Long-term loans 8 million. Because total asset equal total liability. So total asset equal total liability. That's the equation I'm applying. Okay. So total asset which is equivalent to total liability. Total liability. So this is liability. Paid up capital liability. R&S liability. Long-term loans liability. Current liability 4 lakhs. That is also liability. 4 million. This is called total liability. Total liability. See, total liability is equal to total asset. 5 plus 3, 8. 8 plus 8, 16. 16 plus 4, 20. So 20 million is equal to total asset. 20 million equal to total asset. That's it. Please substitute. So 20 million in the formula. So 20 million into 20 million. That's it. Please substitute the formula. That's it. Next one. That's it. Please check it out. What is equity? Equity is equivalent to paid capital and reserves. That's it. This is called equity. Equity is equal to equity share capital plus R and S plus R and S. 5 plus 3, that is equal to 8. 8. So equity is equal to 8. 8. Sales already given 40 million. What is sales 40 million? So 40 million sales already given 40 million. 40 million sales. Net profit 5 million. Net profit 5 million. That's it. Net profit 5 million. That's it. Net profit 5 million. That's it. That's it. Now, so please find return on equity. That's it. Everything given clearly. Please check it out. What is ROE? ROE. Please find ROE. So 5 by 40 into 40 by 20 into 20 by 8. That is equivalent to 0.625. Can you convert in terms of percentage? Yes. So ROE is equal to 0.625 into 100. This is called DuPont chart, relationship between net profit by sales, sales by total asset, total by equity. Net profit by sales is equivalent to NP ratio, net profit ratio. This is asset turnover ratio. This is equity multiplier. That's it. So multiplying these three values, you'll be getting ROE. So here, can you convert in terms of percentage? Yes. ROE is equal to 62.5%. That's it. ROE is equal to 62.5%. That's it. Now, how much they want to increase now? 7.5%. 7.5%. Correct now? Up old ROE 62.5. Then new ROE, existing ROE 62.5% plus 7.5 they want to increase. 7.5 they want to increase. So 62.5 plus 7.5, that is equal to 70%. And that is equal to 70%. That's it. That is equal to 70%. That's it. This is new ROE. So question is, so what is increase in desired increase in ROE? So on 7.5. So total ROE, new ROE is going to be 70%. That's it. 70%. Let's say what is new ROE required? 70%. 70%. Okay. The question is, if you want to increase the existing ROE from 62.5 to 70%, but definitely NP also going to be changed. How much NP going to be changed so that we can get 70% here? So that we can get 70% here. Correct now? That's it. So very simple idea, right? Apo new ROE, I'm supposed to get 70%. 0.7. In this case, what is my NP by sales? How much it has to change? Remaining things 40 by 20, no change. 40 by 20. 40 by 20, no change. Here also 20 by 80, no change. No change. Only thing is NP by sales, it has to change. NP by sales, it has to change. So 40 by 20 to 20 by 8 is going to be 2.5. Here is going to be 0.7. So NP by sales is equivalent to 0.7 by 2 into 2.5, that is 5. So 0.75 by 5. 0.7 by 5. That is equivalent to 0.14. So net PV sales, can you convert in terms of percentage? Yes. 0.14 into 100. 0.14 into 100. So 0.14 into 100. That is equal to 14%. That's it. Now the existing one, this is new net profit ratio, NP ratio. Old NP ratio, 5 by 40, 5 by 40. Old NP ratio 5 by 40, 5 by 40 into 100, that is equal to 12.5%. Old NP ratio. Old NP ratio 5 by 40, 12.5. That's it. Now, what is increase in NP? Increase in NP, that is equivalent to 12.5. That is equivalent to 14% to 12.5%. That is equivalent to 14 minus 12.5. That is equal to 1.5. 1.5. Automatically, it's going to change by 1.5. That's it. We increase in NP by 1.5%. That's it. That's the question number. How much change needed in the NP margin to get to meet the 70%? To meet 70%, to meet 70%, new NP margin is going to be, it has to be 14%. When NP margin attain 14%, automatically new ROE becomes 70%. Automatically existing NP ratio 12.5, new NP ratio 14. How much it has to change? 1.5 it has to change. 1.5 it has to change. That's it. 1.5 it has to change. That's it. Let's see 2012 paper. The total asset turnover ratio and the total asset by net worth ratio is given for ABC company 1.75 and 2. The net profit margin ratio company is going to be 8%. How is it going to be? ROE is going to be changed. ROE. Then you have to apply DuPont model, DuPont chart. Now you have to apply DuPont chart. According to DuPont chart, ROE is equal to PAT by sales, and net profit by sales, NP margin, NP ratio into asset turnover ratio, into NP ratio into asset turnover ratio into so total asset by net worth. That's it. Which means equity multiplier. That's it. NP ratio PAT by sales. Asset turnover ratio sale by asset. That's it. Total asset ratio. So total asset by net worth. That's it. By net worth. That's it. Let's see one by one. First, total asset turnover ratio. Given. So total asset turnover ratio is going to be 1.75. Total asset by total net worth is given. That is going to be 2. NP ratio is given. That is equal to 8. Can you multiply all three? All three. So 8 into 1.75 into 2. 28%. So ROE equal to 28% by using DuPont chart. Return on equity. Right? So sales cut, asset cut, net worth by PAT, that is equal to 28%. That is equal to 28%. That's it. That is equal to 28%. That's it. Let's see next one, 2013 paper. The balance sheet of XYZ Limited company given for the year ended 31/3/2013. First one, let me read one by one. 31/3/13 balance sheet is given. Equity share capital 5 lakhs, preference capital 2 lakhs, general reserve 1 lakh, secure loan for the company 3 lakhs, secure creditor is going to be 1 lakh, land and buildings 1 lakh, machinery 4 lakhs, furniture 50,000, inventory 3 lakhs, debtors 3 lakhs, cash and bank balance of 50,000, so totally 12 lakhs. Calculate the following ratios. From the given balance sheet. This current ratio, proprietary ratio, debt equity ratio, capital gain ratio. 4 things you have to find out. Let's see one by one. First one, current ratio. What is required for current ratio? Current ratio means I need current asset by current liability. That's called current ratio. What is current asset? Inventory, current asset. Debtor, current asset. Cash and bank, current asset. Please add these 3 things. 3 lakhs plus 3 lakhs, 6 lakhs plus 50,000, 6.5 lakhs. So current asset 6.5 lakhs. Current liability, only secured creditors. That is 1 lakh. That is 1 lakh. That is 1 lakh. So current as a 6.5 lakhs. Current liability 1 lakh. So current ratio 6.5. 6.5. So current ratio 6.5. That's it. So first question, current ratio 6.5. Next, proprietary ratio. Proprietary ratio. So proprietary ratio. So proprietary ratio is equal to. So proprietary ratio is equal to shareholders funds by total tangible assets. For tangible assets. Total tangible assets. So they are all tangible. You can touch data, inventory, cash and bank, furniture, machine, everything you can touch. But anyway, shareholder funds is equal to these three: equity capital, preference capital, general reserve, because shareholder funds. So 5 lakh plus 2 lakh plus 1 lakh, 8 lakhs. So 8 lakhs equal to proprietary fund, shareholder funds, 8 lakhs. 8 lakhs equal to proprietary fund. So total tangible assets equal to 12 lakhs. 12 lakhs. So total tangible assets equal to 12 lakhs. 12 lakhs. So 8 lakhs by 12 lakhs. 8 by 12. 8 by 12. 8 by 12 is going to be point. 8 by 12 is nothing but 0.666. 0.666. Next one, 0.666. 0.66 property ratio. Right. Next one, debt equity ratio. Debt equity ratio. So debt equity ratio. So debt equity ratio is equal to, so total long term debt by so shareholders fund. My total long term debt by shareholders funds. That's it. That's it. A total long term debt. So total long term debt is going to be this one, secured loans. This long term debt is secured loans, 3 lakhs. 3 lakhs. 3 lakhs. Total long term debt is 3 lakhs. Shareholder funds 8 lakhs. 8 lakhs. G by 8. So 0.375. So 0.375, that is debt equity ratio. 0.375. 0.375 debt equity ratio. That's it. So 0.375. That's it. Debt equity ratio. Next one. So capital gearing ratio. Next one, capital gearing ratio. The purpose of capital gearing ratio, no? How much fixed income securities you have over equity funds? That's it. Over equity funds. That's called capital gearing ratio. So capital gearing ratio is equal to fixed income securities. Fixed income securities. That is nothing but your debenture, your loans, your preference capital by equity funds. By equity funds. That's it. So your debenture, loans, preference capital by equity funds. Equity funds. How much debenture? There's no debenture here. Nil. How much loans you are having? 3 lakhs. How much preference capital? 2 lakhs. How much equity funds? Equity capital plus plus reserves. Equity funds is equal to equity share capital plus reserves and surplus minus any miscellaneous expenses. There is preliminary expenses written off that you have to subtract. What is equity funds here? Equity share capital that is equal to 5 lakhs. What is R&S? Reserve surplus? That is general reserve 1 lakh. General reserve 1 lakh. 1 lakh. This is equity share capital. This is general reserve. There is no incorporated expenses unwritten off. There is no incorporated expense unwritten off, which means any incorporation expenses unwritten off. Sorry, it's unwritten, not written off, unwritten off. Any incorporated expense unwritten off that you have to subtract. That's it. That's it. Denominator. Okay. So 3 lakhs plus 2 lakhs, 5 lakhs numerator. 5 lakhs plus 1 lakh is 6 lakhs. 6 lakhs. That's it. So 5 by 6. It is going to be 0.833. That's it. 0.833. 5 by 6 is going to be 0.833. That's it. So this is going to be 0.833. Here you can put 0.833. That's it. So 0.833. That's it. That's it. Let's see one by one. To the 14th paper. Many 8 marks. The following information relates to N Limited for the year ended 31/3/14. Fixed asset to sales 2:1. Current ratio 2.5:1. Liquid ratio 1.4:1. That is liquid asset by liquid liability. Current ratio, current asset by current liability. So debt or done ratio is going to be credit sales by average accounts receivables 12 times. Debt by equity ratio, long-term debt by equity ratio 1.1:2. Current asset by fixed ratio 1:3. Working capital 15 lakhs. All sales are on credit sales. All sales on credit sales. Calculate current asset, total asset, sales, debtor, inventory, net worth, long-term debt, cash and bank balance. These are the questions they are asking you. So you have to use all the ratios, but hint is given only 15 lakhs here. Working capital is hint given. That's it. Let's start with always working capital current ratio. Always you have to take. Whenever working capital and current ratio given, always you have to take current ratio and the working capital. You have to take always first preference. That's the first priority. So current asset by current liability. Working capital, current asset minus current liability. So current ratio 2.5:1. 2.5:1. Working capital 15 lakhs. 15 lakhs. Current ratio 2.5:1. Working capital 15 lakhs. 15 lakhs. 15 lakhs. So current asset is equivalent to 2.5 into current liability. Current asset is 2.5 into current liability. What is current asset? Please substitute here. Current asset 2.5 into current liability minus current liability, that is equivalent to 15 lakhs. 15 lakhs. 2.5 CL minus 1 CL, 1.5 CL. That is equivalent to 15 lakhs. So CL is equal to 15 lakhs by 1.5. By 1.5. That is equal to 10 lakhs. So current liability, that's it. The current asset is equal to 2.5 into CL. 2.5 into 10 lakhs. 2.5 into 10 lakhs. That is equivalent to 25 lakhs. 2.5 into 10 lakhs, that is equal to 25 lakhs. That is going to be current asset. So current asset 25 lakhs, current liability 10 lakhs. Okay, the first question, current asset, yes. Known. How much? 25 lakhs. So 25 lakhs rupees current asset. Right. Let's start with one by one. Slowly, we'll do it. Right. Next one. Current ratio working capital we found. Next, my target is liquid ratio. to get inventory, to get inventory. My target is in liquid ratio to get inventory. To get inventory, right? Next one, liquid ratio. Liquid ratio is equal to liquid asset by current liability. It is already given 1.4 is to 1. 1.4 by 1. Liquid asset by current liability. That's it. Already we know current liability. That is equal to 10 lakhs. So current liability 10 lakhs. 10 lakhs. That is equal to 1.4. Liquid asset is equal to 10 lakhs into 1.4 into 1.4. 10 lakhs into 1.4. So 10 lakhs into 1.4. That's it. 14 lakhs. 14 lakhs. 14 lakhs. So stock is equal to current asset minus liquid asset. Current asset 25 lakhs. Liquid asset 14 lakhs. 25 minus 14. 25 minus 14. That is equal to 11 lakhs. 11 lakhs. That is equal to stock. 11 lakhs. Stock 11 lakhs. Inventory 11 lakhs. Stock or inventory 11 lakhs. Inventory 11 lakhs. That's it. So, okay, my next one. My target is on. That is over. Let's see one by one slowly. So all sales are credit sales. Stock is known. Next one, current asset by fixed asset. This target I can have. Current asset by fixed asset. Current asset by fixed asset. Right. So current asset by fixed asset, that is equivalent to 1:3. 1:3. 1/3. 1/3. Current asset 25 lakhs. Current asset 25 lakhs. By fixed asset question mark. That is equal to 1/3. 1/3. 1/3. So 1 into fixed asset, fixed asset. So 3 into 25 lakhs. That is equal to 75 lakhs. 75 lakhs. So fixed asset 75 lakhs. 75 lakhs. So fixed asset 75 lakhs. $75 lakhs. So total asset they are asking, we can find, yes. Total asset is equal to current asset plus fixed asset. Current asset 25 lakhs. Fixed asset 75 lakhs. So 25 plus 70 is equal to 100 lakhs. 100 lakhs. So 25 plus 75 is equal to 100 lakhs. 100 lakhs. So total asset is equal to 100 lakhs. Right. Next one. Fixed asset by sales. My next target on fixed asset by sales. Fixed asset by sales. Fixed asset by sales. That is equal to 2:1. 2/1. Fixed asset 75 lakhs. A sales. 2/1. 2/1. 2 by 1. So sales is equivalent to 75 lakhs by 2 by 2. Sales 75 lakhs by 2 is equal to 37 lakh 50,000. That is equal to sales. So 37 lakh 50,000 that is equal to sales. Sales. Sales equal 37 lakh 50,000 sales. Please check it out. Fixed asset by sales 2:1. Fixed asset by sales 2:1. Fixed asset 75 lakhs by sales. 2 into sales. That is fixed asset. Sales equal to by 2. 37 lakh 50,000. That's it. Is it correct now? Please check it out. Fixed asset by sales, correct. Fixed asset to sales ratio, correct. 2:1. Fixed asset to sales. Fixed asset to sales is equal to 2:1. So fixed asset to sales, please check it out. That's correct. Okay. So that's it. Fixed asset by sales 75 lakhs. 2:1. Sales equal by 2. That is equal to 37 lakh 50,000. That's it. So sales 37 lakh 50,000. Sales 37 lakh 50,000. Sales. Right. Next one, debtor. Debtor. Next target, debtor. Debtor donation 12 times. 12 times. 12 times. Debtor is equal to credit sale into average collection period by 365. What is credit sales here? So 37 lakh 50,000. So 37 lakh 50,000 into average collection period is going to be 12 times they're giving. 12 times they're giving. Correct? No? Fine. Automatically, we can use another formula instead of this. Debtor turn ratio is equal to credit sales by debtor. We can apply this one. We can apply this one. Okay. What is debtor turn ratio? So 12 times. What is credit sales? What is credit sales? 37 lakh 50,000. Right now. So credit sales. So 37 lakh 50,000 by debtor. By debtor. So debtor is equal to, so 37 lakh 50,000 by 12 by 12. So 37 lakh 50,000 by 12. That's it. It's going to be 312,500. It is debtor. 312,500 debtor. So 312,500 is going to be debtor. So 12,500 by 12. That's it. It's going to be 312,500. 312,500. That's it. That are going to be 312,500. That's it. Please check it out. 312,500. Okay, right done. Okay, right. So data 312,500. That's it. Okay. Next one. Long-term debt by equity 1 by 2. Long-term by equity 1 by 2. 1 by 2. That's the last one. Okay. See, liability side we have equity, long-term debt, current liability. That's it. Already we know current liability. Already we know current liability. What is total asset? 10 lakhs, 100 lakhs. What total asset? 100 lakhs. So total asset 100 lakhs. But total liability also 100 lakhs. Total asset 100 lakhs. Our total liability also 100 lakhs. Out of this, what is current liability? 10 lakhs. Current liability 10 lakhs. 10 lakhs. 10 lakhs. So current liability 10 lakhs. Balance equity and long-term debt. Equity and long-term debt. So equity long-term debt, they're related by 1:2 ratio. 1:2 ratio. So equity a long-term debt 1/2 ratio. So equity plus long-term debt will comes around 90 lakhs. 90 lakhs. See, this is 10 lakhs. Balance 90 lakhs equity liability. That's equity by liability. That's it. So equity plus liability, equity liability, that is equal to 90 lakhs. 90 lakhs. Okay. But equity, debt by equity related by 1/2. Debt equity plus debt is equal to 90 lakhs. Equity plus debt is equal to 90 lakhs. But here debt by equity 1/2. Debt by equity 1/2. Debt by equity 1/2. 1/2. So debt is equal to 1/2 into equity. It is equal to 0.5 into equity. Debt is equal to 0.5 into equity. That's it. So debt is equal to 0.5 equity. This is equity. Is equivalent to 90 lakhs. 1 equity plus 0.5 equity, 1.5 equity. 1.5 equity is equal to 90 lakhs. 90 lakhs. So equity is equal to 90 lakhs by 1.5. Nine lakhs 1.5, that is equal to 60 lakhs. Equity 60 lakhs. Equity 60 lakhs. Balance debt 30 lakhs. Then total 90 lakhs. That's it. That's the idea. Then equity 60 lakhs. Equity 60 lakhs. That's it. So net worth equal equity, that is equal 60 lakhs. Net worth equal equity, that is equal 60 lakhs. Debt 30 lakhs. Debt 30 lakhs. Debt 30 lakhs. In current cash and bank balance, balance item. Balance item. Okay. Let's start with the current asset. Let's start with current asset. That is equal to debtor, stock, cash. Current asset 25 lakhs. Debtor 312,500. 312,500 debtor. Stock inventory 11 lakhs. 11 lakhs. So balance cash. So 25 lakhs minus 312,500 minus 11 lakhs, that is equal to 1087,500. That's called cash. 1087,500 is called cash. That's it. So 1087,500 is called cash. Please check it out. 1087,500 cash. 1087 fine is called cash. That's called cash. 1087 fine is called cash. The cash and bank balance 1081 fine. That's it. That's it. So all the things we've used, all states of credit says yes, all the data we used. That's it. So 8 marks. That's it. So cash and bank balance 1087 fine.